This is such a huge news day. What exactly is the biggest driver in your mind for these global markets right now, given that we've seen Brexit happen, a possible phase one happen? Are all of these things going to eventually start to put a risk-on environment back in the market?
Oh, absolutely. I think today is going to be a real key risk-on day. You know, what you've had is two of the key risks that have been hanging over markets for much of 2019 and at least part of 2018 have been lifted today. Now, so I think as we go into the rest of the end of the year, into January, then this should continue. But I would say that as we get into Q2 and maybe the second half of next year, maybe some of those concerns could slightly return to the market.
So the markets are at record highs in the United States. We've seen multi-year highs in many other parts of the market. If the UK election and what's happening with the phase one trade agreement actually are the propellants of it, how much more upside is possible, and how much more do we need to see for investors and traders to say, okay, now I really do believe it?
Well, I think that this is almost enough to propel the markets further. You know, a lot of this had been priced in fairness, with a few concerns in the last few week or so about what could happen, certainly with the UK election, which had pulled markets back a little bit. Now, from here, I think the key thing is that you are looking at global growth recovery now that we've taken off those key risks, which are hanging over investor sentiment, business confidence, consumer confidence. So that should push markets further. We also know that we have central banks on hold, which means that you have that continued flood of liquidity. But what this means is that for some parts of the world, equities are extremely expensive, especially US equities. So what we're expecting is with this continuation of a risk-on environment that we've seen today, you would see a reallocation away from US equities potentially towards emerging markets and European equities, and kind of a more risk-on trade with cyclicals as well.
So that risk-on trade, especially in places like in Europe, does that also translate into what's happening with the United Kingdom? Because we are seeing some nice moves higher in the FTSE 100. Is the UK scenario now clear? Can Brexit actually be delivered? Or is this a situation where this could take months, if not years, to really get an overarching trade agreement done between the UK and the EU?
Yeah, look, you raise a really crucial point here. UK assets can do well for the first few months. But at some point in Q1 or Q2, there's going to be concerns returning to the market about really how much can Boris Johnson do to inevitably to make sure that we get that trade deal done within the space of 11 months. You know, you have to think, we spent the last 3 years talking about this trade deal with not really that much progress. And you've rarely ever seen two major countries come to a trade deal within the space of 3 years. So this is very, very fanciful. We do expect there's some concerns about a no-deal Brexit returning to the market. But really, it depends now, because Boris Johnson has such a large majority. It depends how important those ERG, those Brexiteers, are really going to take in the future negotiations from here.
All right, so that's topic one. I want to save time because I've got two other points that we want to try to get through. U.S.-China trade. How optimistic should we be that this particular phase one deal leads to something bigger in terms of the overall agreement between the U.S. and China?
I'll be honest, I don't think we should be too optimistic. I think we should be happy with what we have. You know, the key thing that the market was looking for was that lifting of that December 15th tariffs that was really hanging over consumer spending for the next few months. Now that's been lifted, that's great. But in terms of the other issues, such as technology transfer, intellectual property rights, all of those things are probably going to take much, much longer to resolve. So what we're hoping for is that we have almost a stalemate from here through to the US presidential elections, and then maybe in 2021, with whoever the president is, either President Trump or somebody new, from there, maybe negotiations may proceed. But I think for the time being, this is something that markets should be happy about, but not really expect too much more.
All right, so happy but not expect too much more. That brings us to our third topic here, which is the economy, both globally and the United States. Let's talk about the United States first, because it is holding up relatively well. The employment picture is good. So can the U.S. economy still, in this case, power the global economy? And will that mean the global economy in 2020 is due for a nice bit of a rebound to justify some of the valuations that we've seen in markets across the world?
So I think what we've seen is that we are seeing very clear signs of stabilization, and certainly the news on the trade front is encouraging. Having said that, I don't think it's necessarily the case that we need the US to really power through for the global economy really lifting it, because we will have growth in other parts of the world. So, for example, the Chinese economy, we expect it to stabilize now that you have got an element of a trade deal. We think the European economy is stabilizing. We're not expecting a very vibrant upturn by any means, but this will be enough to at least keep markets up. And the most important thing from here, though, is actually central bank liquidity. We know that there is very little chance that central banks are going to be raising rates in the foreseeable future. So this really puts a bottom underneath all the markets going forward. And it really means that for us, we do continue to believe that investors should be fully invested in risk assets.